This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Lance Roberts, who hasn't been with us for a while, but welcome back, Lance.
I'm more than happy to be here. Thank you for having me.
We've had a lot of new listeners. Some of them may not be familiar with your background. Could you just give them a bit of an understanding of things you work on, what you do?
Yeah, absolutely. I started my career back in 1987 doing basically running matchbooks for banks, CD deposits, those type of things, and graduated from there to actually doing a lot of international finance, real estate transactions, and high net worth money management overseas. Came back in the late 90s and opened up my own broker-dealer, started running just kind of institutional money management services on a platform dealing with high net worth and institutional money. And then in the last few years have migrated down to just basically working now, doing a lot of economic analysis and a lot of financial analysis and applying that institutional money management now to high net worth individuals that are approaching or moving into retirement. Because what my feeling and my philosophy was is institutional money management's great, but really what happens for the individual is that they don't manage money, they don't control risk, and so applying real risk controls and risk management is what individuals are sorely lacking, and there's a great niche for that.
You mentioned risk, and that's one of the things I want to talk about here this morning, and that is I believe there's a tremendous amount of market distortion going on based on the degree to which we're seeing buybacks and dividends occurring by corporations. Not that they in themselves, it's bad. But like anything, when it gets too distorted, it can cause problems, and it compounds on itself. I think we can start, Lance, with some slides that you brought that really show the degree to which buybacks and dividends are occurring. Then talk about the risk involved here.
Well, absolutely. And if we take a look at just how companies have been manufacturing earnings, and there's what I have a chart called Accounting Magic that I keep a watch on a regular basis. And it's very interesting when we look at that, because when you take a look at how companies have been manufacturing earnings, it's really telltale about the real health of the underlying economy. And that's what you and I are really interested in. How, we have a lot of boost on Wall Street because of the Federal Reserve interventions. We were inflating asset prices. But this has really acted as one of the greatest reverse Robin Hood effects ever in history. We've had the biggest single wealth transfer from the middle class to the upper wealthy class in the last 5 years than we have ever before in history. And because of that, when you look at how corporations are reporting earnings versus what they are reporting at the top line. So on an income statement, we have our sales at the top line. Then you extract your expenses, you wind up with gross profit. Then you extract your expenses from operations, you wind up with net profit, and ultimately divide that and get your earnings per share. Well, the problem is that since 2009, sales on the top line dollar coming into businesses has only grown by a total of 33%. Not 33% a year, 33% in total. Bottom line earnings have exploded by over 255%. How do you do that? How do you take a dollar and convert it into multiple dollars of earnings? Well, you do that beneath the bottom line where you're starting to manufacture the actual accounting issues. When do you account for something occurring? When do you defer it to somewhere else? How do you write such and such expense off? That is where this is coming from. The problem is that it's the sales at the top line that are representative of what's going on in terms of the real economy.
Exactly. It's the top line where you see job growth, and you see it on Main Street, not on Wall Street. And
absolutely.
It's one thing for that distortion to happen, but when it happens and it's for a protracted period of time, then it causes real problems. And I would suggest to you that we're now reaching that particular stage.
Absolutely. And this is why, when I've read a lot of articles lately from individuals saying, well, CapEx is getting ready to just explode here. Companies are getting ready to just start spending like crazy. No, they're not. And the reason they won't is they are going to spend money. Don't get me wrong. There is going to be capital expenditures. They're going to spend money on increasing productivity. They're going to implement more technology, and I talk about this quite often, that more and more companies are getting rid of receptionists, and they're replacing them with automated answering machines and dial trees, because that's an individual that they don't have to pay salary to. More importantly, with the impact of the Affordable Care Act, which is greatly increasing the level of insurance premiums that companies will have to pay out, they're looking for more ways to cut those costs and benefits. Payroll and healthcare benefits and benefits in general are the two largest single expense items on any balance sheet or in the income statement. So reducing those, that is a primary focus. And this has been the focus of corporations for the last 5 years. Cut costs, cut costs, cut costs.
I would argue that, and I totally agree with you, Lance, but I would argue that it's beginning to accelerate from already fast speeds. And the whole advance of, we're all very familiar with some of the things you mentioned, but robotics and bots and that technology, we say, yeah, we know, but it's moving at blistering speeds. And for example, the whole service industry, which has been somewhat protected from it, retail ends of it, waiters and in the service sense, now we're seeing a wave of kiosks and robotics going into that particular area. McDonald's automating their ability to do Big Macs. Denny's, they're putting in their automatic waiters, so you sit at a table and you can order and it's automatic. And I could go on with the technologies that's coming in waves.
And that point is crucial, because this is one of the arguments I've had about this whole minimum wage argument coming out of Washington, which is we need to raise the minimum wage. That's fine. You can raise minimum wage. When you do that, you're going to accelerate, to your point, more automation. How hard is it to go into McDonald's and instead of having somebody push the buttons for you on a kiosk to order your meal, you do it yourself and it comes out on a conveyor belt? That is not a far stretch to get to.
Precisely. The other element that's driving it is also the nature of the competition, and I'll use the expression that time is now the competitive dimension. Things have to move quicker and faster for a number of reasons. Blatantly, product life cycles are shorter and shorter right now, so that often products only last for 6 months. And I can remember not too many years ago where we had 85% of next year's revenue still on the design board, and that's getting shorter and shorter. So what does that mean? It's not only do you have to have everything automated, electronic movement through the whole supply chain to be able to handle that, but also, and this is really critical, taking risk becomes a real problem on that top line. You make major decisions on that top line, you don't get it right, you lose a lot amount of money. Look at the technology companies, for example, that are here today, have something and are gone tomorrow. So when you're looking at investments, these corporations have said less risk down here below the operating line to leverage my earnings than taking high risk up here at the top. There's a balance for organic growth, but they have pulled in their horns because a lot of this, certainly the technology risk, but a lot of this risk is so difficult. And it's just not in the technology. You go right through the shelf life of articles, the publications, the media. Used to be you'd write an article and you'd be around for a couple of days. Now, an hour and a half, and it's gone.
Yeah, I know that feeling.
I can go through industry after industry. And bottom line of all of this, besides what's happening with the forcing them to do buybacks and dividends, is jobs. The absolute cutting of jobs. And if there is a job, it's part-time without the benefits. It's a job that doesn't earn an employable income to support a family. And therefore, aggregate demand is shrinking. And aggregate demand is shrinking in the world.
Well, and if you just look, and it's very interesting because, we just got, yesterday, we just got the fourth quarter, the final revision to fourth quarter GDP. And it was ticked up to 2.6%. And it was driven by a surge in consumer spending. Where was that spending? Was it in people going out and buying new washers and dryers and buying new cars and these type of things to really, increase their life? No. It was in services. It was primarily in utility costs as they were fending off these polar vortexes that were sweeping through. That's money that they didn't have available to spend, but they had to spend it in order to heat their homes, etc. The problem is now is that there's lack of demand push that will come through over the next couple of quarters for other items that they are now don't have money to spend for. The next iPad, the next iPhone, those are going to be where you're going to see the impact of that come from.
You got some other charts here on the buybacks and the dividends, just the magnitude of this problem.
One of the issues is that stock buybacks, and one that we talk about is that in order to one of the easiest way to manufacture earnings per share, and this is kind of the fallacy of the way that we look at corporate income statements and balance sheets. We go, what's the earnings per share? Well, that's very deceptive if I can change the number of shares outstanding. And one of the things that we have seen going on with companies in particular that is going to have a longer term effect is companies going out and borrowing money at very, very cheap levels. They can do it off balance sheet, and then they come back and they buy down their own shares. They do these big, massive stock buybacks. Take a look at IBM as an example. IBM just reported their earnings. Primarily, a big chunk of that was due to the fact that they were buying back shares in order to make their earnings. Had you extracted that share buyback, they would have actually missed their earnings. And in fact, if we look across the board, the total number of market capitalization has been dropping, not as prices are increasing, but it's been dropping because of the run of share buybacks. So we're seeing surging operating earnings, we're seeing surging reporting earnings, but it's not necessarily what it seems at the top line once you factor in the impact of those stock buybacks.
If you look at corporations and valuations, their enterprise value, it really gets down to their ability to generate cash flow, and EBITDA or EBIT. And what's happening on a corporate basis, I know they're flush with cash, but they're not generating new cash anymore. It's actually now barely positive and going negative. These corporate executives and boards are fully cognizant of that. That's one of the reasons they're hoarding the cash that they have. They're bringing in more cash that they can leverage up for that, and also for corporate protection to be taken out.
That's right. And if you take a look at the leverage that's on balance, we hear a lot of people talk about, corporations are as healthy, they're more healthy than they've ever been before. Not really. If you take a look at corporate assets versus corporate liabilities, we're back to approaching levels of leverage from that standpoint that we saw back at the peaks of the market in 2000 and 2007. So, we're seeing that increase just because of exactly what you're saying. We're seeing the increased use of leverage and the increased use of outside cash to supplant the lack of cash flows that are coming in at the top line, as we talked about earlier, the actual sales, which have been fairly stagnant and really more a function of population growth rather than actual demand growth.
Why these distortions are so critical, Lance, to me, is because the capitalist system is based on the fact of savings, and that is corporations making investments that are not malinvestments, and it creates money, creates savings, and that's how we grow. But we have distorted this with cheap, free money. And these kinds of mechanics that are driving corporations, I'm not trying to criticize corporations, but what drives their behavior right now. So now we've moved to something where it's not about savings, it's about credit, and it's not about investment, it's consumption in a consumption economy. That works for a period of time. But then it stops working because when the investment, which is clearly stopped, jobs are impacted. And when jobs, as you said, when jobs are not growing, both at a real disposable income base and an absolute base, aggregate demand shrinks. And aggregate demand is, in fact, shrinking on a global basis, the rate of increase. And that's the problem. And once you get into that trap, the only way out of it is large-scale employment. And that's why the last G20 meeting, they said they had to create tens of millions of new jobs and $2 trillion worth of new liquidity.
And what was interesting about that is when they left, they had actually no idea how to actually achieve that, but it was a great concept on the surface.
Not a single solution idea, but I do believe they know how they're going to do it. They're just going to print it.
Sure.
Compounds the problem.
Yeah, I was going to say, and welcome to Japan worldwide now. And, this is kind of fascinating to me is that the things that we're doing, we're watching Japan real time do the same thing that we're doing here. And we're seeing that they're getting no net positive effect from any of these actions, and yet somehow we expect that we're going to be different.
What happens when you do this, because you're effectively bleeding off in a capitalist system real savings and real investment, when that money gets bled out of the system, is not properly being returned, you effectively pay for it. And by that I mean a capitalist system is, by the system you get more for less. because you're the competition. But when you don't have that, you end up getting less for more. Whether you call it crony capitalism, monopolist, predatory actions, but all of a sudden the system squeezes. So you find inflation coming in everywhere you turn for the wrong kinds of reasons. Right now, people like asset inflation because they think they're making money on it. But at some point, we will also start to see price inflation right across the boards. You know, real estate goes up. Shop owners has to pay more for rent. He's going to charge you more for food. And we're starting to see food and these things starting to break now on an upward trend. But I need to make one point. I still believe we have more deflationary problems immediately in front of us, Lance, and I say that because of non-performing loans and collateral that right now is mispriced and is non-performing. So we have some real problems there.
I absolutely agree with you on that point. I have a chart that actually update on a regular basis, and I actually just wrote a piece earlier this week on our website talking about the deflationary pressures that are currently overlaying the market. And if you look at inflation is really a function of three things. It's the function of how fast money's flowing through the system. So are people borrowing money from banks to go start new businesses and expand opportunities and increase productivity, which creates more jobs and more consumption? That answer is no. M2 money velocity is falling sharply. Do we have wage inflation, which if we have wages going up, people can buy more, which creates more demand, which allows shop owners and producers to increase their prices? That answer is no. Wages are falling. Do we have any commodity price inflation really to speak of? And no, if we look at a broad commodity index, we're seeing deflationary pressures there as well. Now, we do have pockets of inflation, as you talked about. Insurance, college tuition, food prices have been going up. Obviously, gas and oil prices are going up. So there's pockets of inflationary pressure. And unfortunately, those pockets of inflationary pressures are the ones that impact directly the homeowner. In other words, apartment prices are going up because of the demand for apartments because individuals can't afford to buy a home. Home prices have been going up because of the speculation by companies like Blackstone and others that have been buying mass strips of houses to convert them into rental properties. So that's pricing individuals out. The cost of food and gas is going up, but that's what impacts people at home that are trying to pay their bills. And of course, utility costs going up because when you have these things like polar vortexes that demands more usage, prices move up there as well. The problem is one of the biggest impacts of deflation, which is where I agree with you, is on wages. Wages are going down. The cost of immediacy of living at home is going up. That gap is being filled by credit, and that is the one area that is still a net drag on the overall economy is the level of leverage and the overall market. Let me give you an example of that very quickly. Between 1980 and 2000, consumption as a percentage of the economy grew from 61% to 67%. It took $6 trillion in increase in debt to get that increase of 6 percentage points of consumption relative to the overall economy. Between 2000 and today, the consumption as a percentage of the economy has moved from 67 to 68%. That 1% increase required an additional $6 trillion in debt. So in other words, the incremental cost of increasing consumption, increasing economic growth is getting dramatically more expensive because of the leverage in the system.
Lance, regarding this dividends and the buyouts, what's your biggest concern about these distortions going forward? And what should investors be concerned about?
Well, at the end of the day, we buy a company based on their ability to generate future cash flows. We buy, as an investor, we buy a stream of future income. That's what we should be doing. Now, unfortunately, the majority of investors, and there's plenty of studies that show this, simply buy stocks because they're going up, and then that's why we buy tops and we wind up selling bottoms when markets crash. But the issue is that as a real investor, as a value investor, I want to be buying corporate cash flow. I want to be buying future cash flow streams, future earnings of these companies. But what I want to buy is real earnings. I don't want to buy manufactured earnings. Manufactured earnings don't generate value long term. If you take a look at the level of corporate profitability today per employee, we are at the highest level ever on record, historic extremes. That is an impossibility to continue the magnitude of that. Eventually, corporate profitability will have to fall simply as a function of we can't fire everybody. There is a point to where you can only increase productivity so much in a business. You've still got to have some human hands working in there, but there is an inflection point to where increases in productivity have a diminishing rate of return, and you can no longer cut any more employees. So there is these cost-cutting ideas that have been driving to the bottom line are finite in nature. So are accounting gimmicks such as stock buybacks, etc. You can't buy back all of your stock or you'll ultimately be private. So there is a point to where even stock buybacks no longer have an effect on corporate profitability. So the problem that faces investors going forward is that without a lack of real revenue growth at the top line, generating real organic earnings growth at the bottom line, you're buying into a fictitious rate of earnings going forward, and those future cash flow streams will not be relevant to the actual value you're paying today. And that's where you're going to suffer, lower returns on investment.
I've done through a number of charts that have shown that we've actually been in a secular bear market since the dot-com imploded in 2000, if you were to look at real inflation, real adjustment GDP. But the point here is that the investments that have been made since then are not generating real growth. They're not generating the kinds of incomes that we think that we're getting. And back then, you can remember when Enron blew up, Lance, and the testimonies were going on before Congress. And Fastow made this statement that he had 42 offshore, off-balance sheet accounts, and the senators were all aghast. And Fastow looked at the senators, and he was shocked. He didn't understand their point. And he pointed out that GE had 2,400 offshore off-balance sheet entities called SPEs and special purpose entities, etc. My point here is that was almost 14 years ago. And so the degree that we have now taken debt, the leverage of debt through shadow banking, where we're using things like collateral transformations, rehypothecations, we're using the repos and leverage, that generally the investor has simply zero understanding of the real earnings, the validity of the balance sheet of these corporations. Because there is, frankly, no matter how much time you pour over it, can you really determine that? How they use contingent liabilities in affiliates offshore to be able to feed cash flows. So you say they got cash, they've got money. It's fictitious until something hits. And when it hits is when the slowing of that top line, because you can hide a lot of things, but you can't hide that top line growth, deceleration. But we've been in this since 2000. This is nothing new.
Absolutely. And, one thing to that point, and the things that we've really talked about here during this whole conversation today, is there's a lot of people going, well, interest rates, we're in a bond bear market now. Interest rates are set to rise. And I've heard Jim Cramer on his show a couple of weeks ago, and I made some comments about this saying that, well, interest rates going up is really not that big of a deal because we're coming off such low levels. It does make a big deal.
Oh, it's a huge deal.
Well, because and in particularly this case, when interest rates start to rise, look at the rise we've already had in interest rates. Just this little bit has already grossly impacted the housing market because people buy payments, they don't buy houses. But in terms of corporate earnings, a lot of the management of corporate earnings has been driven by these ultra low interest rates, as we talked about earlier, borrowing money at ultra cheap rates. IBM issued a 40-year bond at like 2% to go buy back stock. We've seen lots of companies do this very thing. They are surviving on these ultra low rates. When rates move up and the cost of borrowing reaches a point to where it is no longer a financial advantage of those companies, this is where the wheels come off the proverbial cart in terms of a lot of this management. Well, and that's one of the real risks to the markets going forward that people really aren't paying attention to.
Exactly. Closing comments, Lance, the message you'd like to leave with our listeners here today?
Well, absolutely. I think, look, as I said earlier, my job today is managing money for retirees and applying some level of conscious risk management to those dollars. The markets are going up, and that's great. And we're fully allocated to the markets right now. We're participating. All of our technical indicators are showing signs of deterioration. There are certainly levels to be concerned here, but opportunities to make money in the markets when they're going up is easy. The hard part for investors is replacing lost capital, and more importantly, the most precious commodity that we have as individuals is time. We simply cannot manufacture more time, and we cannot afford to lose capital and time because the proposition of replacing those are near impossible, particularly later on in life. So don't get so swept up into what you hear in the media and you hear and you read in a lot of the bullish biased, blog posts and all the other stuff in the world. Pay attention to the real risk, because ultimately at the end of the day, what you pay for and what you invest in and that future cash flow of real earnings and real cash flows of companies is what is going to determine your future return. And that is the most important thing.
Well said. Lance, could you tell our listeners how they could learn more about your writings and how they could get a hold of you?
Absolutely. Well, simply go to our website at streettalklive.com, and we post a blog post every day. A lot of it is talking about the very same things that you and I talk about, and I try to analyze just the markets from just the risk perspective. If you want the bullish perspective, turn on CNBC. If you want the risk perspective, go to our website at streettalklive.com, and you can get it there.
Lance, I know our listeners really appreciate how frank you've been this morning, and I do too. Thank you very much for your time.
My pleasure. Thank you.
Thank you very much.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.